Hello and welcome to Star USA Training. Today is Tuesday, January 11th, and we'll be talking about USMCA qualification. We are recording this webinar. The slides and the recording and any other materials will be made available after the broadcast. All participants are currently muted, and the Q&A feature is available if you have any questions. I will answer questions throughout, and we will take questions at the end. Today's session is available for one credit, CEU credit for NCBFAA. If you email train@starusa.org after the webinar with your ID number, we'll be able to get that processed so you get your credits. A little bit of background on me. My name is Michael Easton. I am the President and General Manager of Star USA. We just had our 25th anniversary year last year. So I guess technically this 25th anniversary marker is no longer quite accurate. We just hit our 26th anniversary, as a matter of fact, this week. We are a trade compliance consulting advice, training and services company. We handle a lot of outsourced operations for companies that need some compliance support or procedural steps implemented. We do audit and disclosure. We perform HS classification, origin determination, value evaluation, free trade agreements, in particular USMCA being a big one. We handle basically all areas of international trading compliance, and we provide training on those areas. If your company needs a little bit of directed training, or you need to get your sales teams informed, you can reach out to us and we will be the message carriers on that. So today's topic is USMCA qualification, and we're divided into two parts basically. Part one is going to be some of the preparation and understanding we need to have in order to go about performing our USMCA obligations correctly. And part two is looking at some of the methods and practices in use to ensure that your goods are qualifying correctly for USMCA. And again, as we go through, please make sure you're posting your questions in the webinar chat. My goal today is really to provide you with the baseline of requirements. It's not to necessarily paint the entire picture, but I want to give you the building blocks that you can use to implement proper USMCA qualification in your organization. As part of our preparation and understanding, we'll take a look at some of the essential facts, the responsibilities, and the penalty risks. One of the important pieces of the USMCA process is understanding the system of checks and balances that's in place, including the rules and roles that are in place that apply to the different parties in each transaction whenever a USMCA is brought to bear. Knowing where the rules are so you can find them, how to interpret them, knowing your role and which rules apply to you are all essential elements. You also have to understand the key difference in the term originating. We'll take a look at that in a subsequent slide. And lastly, HS classification plays an essential role in qualifying your goods for USMCA. If you do not have your HS classification, you're unlikely to have a correct qualification, or you will not have the substantiation that you need to have in order to verify that your claim was valid, which is a problem. So first, to look at the rules. USMCA claims can be made by an importer based on a certification of origin completed by the exporter, producer, or the importer. So the importer is the one that's responsible for making the claims to the Customs Administration in the country of import. They're the ones that handle that primary responsibility and take on that regulatory burden of proof. But they're basing their proof on the documentation that has been provided to them by the exporter, producer, or importer. And importer being the importer here, there is a special exception for how importers can self-claim USMCA without having the exporter or producer involved. We're not going to go into that too much, but because it is an exception to the rule. But that's basically how the basis of claims are made. The rules for USMCA origination are determined on a product-specific basis. Yeah, I got some beeping going on here. All products within the HS classification system are given a USMCA rule to help determine their qualification status, and you must abide by that rule for each of your products that you're qualifying for USMCA. So whenever you're exporting a good and you want to certify to the importer that this good is USMCA qualified, you have to refer to that rule that applies to your product. There is no blanket rule that covers all products. So you have to be able to identify where your product is located within the Chapter 4 of the USMCA and know how to apply that rule. And lastly, there is a verification element baked into the USMCA trade agreement that allows the country of import's customs administration to conduct a verification on any claim via these 4 steps. Step 1 being a written request seeking information or documents from either the importer, the exporter, or the producer. The Customs Administration can conduct a verification visit to the premises of the exporter or producer to observe the production process. There are specific textile rules for verifications that the Customs Administrations have to follow. And then if there is another procedure that's required, the parties in this case are the Customs Administrations of the 3 member countries. So the US, Canada, and Mexico can agree on what the parameters of the other procedures are. It's important to recognize this verification process is a little bit intimidating. I say a little bit, it's quite intimidating when you as an exporter receive a verification questionnaire from Mexico SAT, Mexican Customs Administration, inquiring about your production processes. So they provide a 8 to 10 page list of questions that you need to respond to. And it's important to recognize that questionnaire is the precursor to a customs visit. Those questionnaires, it's essential that you provide every reason for them not to come. You do not want to have a foreign customs administration coming to visit your premises to verify your steps, because based on my conversations with former employees of the SAT, they don't come to the US to do verifications unless they already have something in their pocket. They've already found something, they know something's wrong. They'll come and find out more, but they're not going to make the trip up here unless they have a good reason to. And so that questionnaire that you get as the starting point is it's essential to get that responded to in such a way that there is no question about your processes, about your practices, that they don't have a reason to come visit you. Go for it, please. Okay, there we go. So some of the special rules that I mentioned on the previous slide, there are chemicals and plastics rules that are prefaced in Section 6 and Section 7 for chemical products and rubber products that allow you to apply a rule either instead of or in addition to the product-specific rule. That's the product-specific rule being the HS rule for those goods. You can apply one of these 8 rules, assuming that the rule is within that purview of the product that you have. And if you meet these rules, your goods will qualify whether or not you are meeting the requirements of the product-specific rule. So you can actually get closer to a blanket certification of your goods if you have your business practices, your production processes, and your documentation requirements in line with these special chemicals and plastics rules. And that's a change from NAFTA that's important for the chemical and allied industries. There are also automotive rules that apply to specific headings, 8701 through 8708, that have other special considerations in addition to the product-specific rules or adjacent to those product-specific rules. And you have to understand how those apply in order to recognize whether your goods are covered just by the product-specific rule or if there are additional considerations to keep in mind. So there's a lot of information on the automotive rules, and they do apply to headings from chapters 40 through chapter 94. So they cover a broad scope if your goods are used in the automotive industries. So some of the key roles defined, it's important to recognize who the parties to the agreement are. I mentioned it before, but the parties as referred to in the text of the rules of origin, in the text of the origin procedures, are the member countries. The parties are Canada, Mexico, and the USA. The certifier is going to be the entity who prepares and signs the official certification, and that may be the producer, exporter, or importer based on the rules that we just talked about a moment ago. The producer is also known as the manufacturer. The exporter is going to be the entity delivering the goods to another party in a different member country. So whoever's exporting the goods from the US to Canada or from Canada to Mexico, that's going to be the exporter. Generally for US purposes, this is equivalent to the US PPI defined in the Foreign Trade Regulations, 15 CFR 30.1. Not always, but in most cases, that's the exporter there. The exporter may also be the producer. There's nothing saying that you can't be both an exporter and a producer. And then the importer is the entity who actually receives the goods from another party in a different member country. And generally, this is going to correlate to your FPPI, your foreign principal party interest, defined in the foreign trade regulations. The agreement does not define, does not care, does not consider who brokers are, who forwarders are, who suppliers, distributors, or resellers, or other third parties are. They only care about the certifier, the producer, the exporter, and the importer. And the certifier is a producer, exporter, or importer. So the producer, exporter, and importer are the three parties that have a responsibility under the agreement. If you're not one of those parties, but you're working with one of those parties, it's important to recognize what that party's responsibilities are so that you can help them comply with their requirements, because the onus is going to be on them. And one of the basics of USMCA in general is understanding the difference between the word origin, originating, and the made in USA requirements. The rules of origin, as defined in 19 CFR 134.1, identify the country of manufacture, production, and growth, so that you can identify what where the articles underwent the most recent substantial transformation, but has nothing, the origin of the goods has nothing to do with whether or not the goods are USMCA originating. Originating has specific requirements under the agreement, and identified in 19 CFR 182.61. The goods have to meet these origination requirements in order to be considered originating under USMCA. It doesn't matter what their country of origin is. They can be country of origin US and not be USMCA originating. There's a different standard that has to be met. And the same thing applies to made in USA. It's a different standard that we're applying. Just because a good is originating under USMCA does not mean it qualifies for made in USA. Under the made in USA terms, they have an all or virtually all requirements in order to be able to be marked with made in USA. So these are different standards, and I want to eliminate the confusion. And we're only talking about USMCA originating today. We're not going to go into the details on the others. And HS classification. Again, I mentioned it's an essential element of performing qualification correctly. When we're talking about HS classification in the context of USMCA, we're focusing on 6-digit classifications because that is the international standard. The last 4 digits in the US would not have bearing on USMCA claims made in Mexico or made in Canada. The goods that need qualified, we need to have qualification applied at both the finished good and the component or the raw material level. The term component, the term raw material are kind of interchangeable in my context today. Finished good is also interchangeable with product in most cases. But in order to apply the USMCA qualification rules, you have to know what the classification of your finished good is, and you have to have the classification of the key raw materials in order to apply the transaction value, the regional value content calculations, net cost method, tariff shift. Those all are based on the tariff classification of the components and the finished good. They form the backbone of the USMCA record-keeping requirements as well, which we'll get into a little bit of the record-keeping requirements, but I expect there to be some questions on how to get the appropriate documentation from your supply chain. And lastly, because this is a regulatory program, it is covered under the CBP penalties provisions under 19 U.S.C. 1592, where you can be penalized for negligence, gross negligence, or fraud in the pursuit of your USMCA obligations. It's important to remember that you do not have to have your goods qualifying for USMCA or not. You do not have to make that determination. But if you do, if you are stating that your goods do qualify for USMCA, then you're going to be beholden to the regulations that govern those practices, and you can be subject to penalties. It's important to note that each member country applies their own penalties to companies within their territory. This is only CBP's penalty model. Mexico and Canada have different penalty structures. And it is also worth noting that you can protect yourself from penalties by using a prior disclosure, particularly in the case of negligence, gross negligence, if there are errors of just mistakes, not fraud. you can actually protect yourself from the risk of penalty by filing a prior disclosure and actually declaring to customs, hey, we made a mistake in the past, and here is the correct information. Here's the money that should have been owed, or here's the money that we should be owed. But you go through the prior disclosure process to protect yourself from those penalties. And they can escalate pretty aggressively. Okay, some of the methods and practices. Here we're really just trying to give you the building blocks, the tools to make a process that works within your shop, help you understand what rules are in play and how they come to bear in your organization. So the qualification methods, USMCA goods are qualified according to the product-specific rules of origin identified in Annex 4B, and it goes through all of the HS classifications and provides a rule to you of what you need to meet in order to qualify your finished good according to the Annex 4B. Those methods include, there are some special rules, the chemical rules that we talked about, the automotive rules that you have to pay attention to. So you need to consider those. But then there's also the tariff shift and the region of value content rules that you can apply based on your HS code and what it says to apply. And we'll look at some of those. There is also an exception to the rule, and the most common exception being the de minimis rule, which states that the value of all non-origin materials used in the production that do not undergo an applicable tariff shift according to the product-specific rule is not more than 10% of the transaction value or the total cost of the good, provided all the requirements are met. You can eliminate that material from your calculations. You can subtract out up to 10% of the value of the goods that is non-originating, so that it can help you meet the rule, your de minimis rule. Specific requirements for applying the de minimis rule are spelled out in Annex 4A. So you would want to, if you're going to take advantage of de minimis, it's important to know where the exclusions apply to the exception. So definitely take a look at that. I do recommend thoroughly reading Annex 4A for a deeper understanding of applying the rules of origin. There's not enough time to run through all of that here, but if you're taking advantage, at least go through and understand what some of the methods are and what they're talking about within that Annex 4A. Okay, so the two rules that we're concerned with today are tariff shift and regional value content. We're going to look at tariff shift first. And tariff shift is the transition from one article in the HTS to another article in HTS. It can happen at different HS levels, at the chapter level, at the heading level, at the subheading level. Since the first 6 digits of the HS are universal, it's very rare to find a rule that goes beyond the subheading level, but there are always exceptions. There are some that do have tariff shift at the statistical or the tariff item levels, which is the 8th and 10th digits. Tariff shift is basically stating that the non-originating components of the finished good must meet the shift in order for the finished good to be originating. The phrase meet the shift means a particular good has transformed at the appropriate tariff level in order to meet the origination requirements under the USMCA. So basically your components are becoming different enough by the time they are added to the finished good that the finished good is different enough from the components to indicate that the goods have met that tariff shift requirement. And the tariff shift requirement is different for each product within the HS. So we're going to look at some of the examples. I'll go through RVC in a moment. I'm not going to look at that right half of that slide yet. We'll come back to that. So some of the text examples of tariff shift. Here's a chapter shift example for 7201, where it states a change to heading 7201 from any other chapter. What that means is your finished good is classified in 7201, but the components that go into your finished good were classified elsewhere, any other chapter outside of chapter 72 in the tariff. And in making your finished good, you have combined materials and components from outside of chapter 72. Another example of chapter shift is a change to subheading 720211 through 720260 from any other chapter. You'll notice there that we're focusing on that from any other chapter portion of the sentence. That's where we identify what type of shift we're talking about, whether it's a chapter shift or a heading shift or a subheading shift. It's based on that, where it's coming from. And this is the same principle. If you're going to be ending up with a finished good in the range from 720211 to 720260, then your components must come from outside of chapter 72. An example of An exception within the rule is 720270, where it states a change to subheading 720270 from any other chapter except from subheading 261310. So 720270 is ferromolybdenum. I didn't hit that right. It's okay. So 720270 is ferromolybdenum, and subheading 261310 is molybdenum ores and concentrates roasted. So if you have a 720270 article and it's made of 261310, you cannot, you have not met the shift. You would be said to have not met the shift required in order to qualify your goods for USMCA. You can still qualify for USMCA. There's an additional step, which we'll look at on the next slide, but you have not met the shift. Heading shift is phrased as a change to subheading 7206 through 7207 from any heading outside that group. Basically saying your finished good is in 7206 or 7207, anywhere, any subheading within there, as long as the components are coming from outside of 7206 to 7207, then your goods will meet the shift. And subheading shift is framed as a change to subheading 401211 through 401219 from any subheading outside that group. And again, outside that group, meaning if your finished good ends up as 401211, then you cannot have any components that are within 401211 through 401219. It's got to be outside that group. So that's a subheading shift. Hopefully that was clear. Let's take a look at a tariff shift example. So the USMCA rule on an armored safe of base metals classified under HTS 830300. The USMCA rule for this product is captured within 8302 to 8304. Notice it does not specifically state 8303. I have a good of 8303. The rule does not specifically state 8303. It is included within that hyphen there. So the rule states a change to heading 8302 through 8304 from any other heading, including another heading within that group. So I need to transition at the heading level. My bill of materials for my armored safe, I have a safe body that I've imported from Japan, classified as 8303. It is a non-originating article. I have a dial that I'm going to affix to the face of the safe body. The dial is classified under 392690. It is made in the US and it is originating. And then the screws to affix that dial are classified as 731850, and they come from Mexico and they are non-originating. According to the transaction value tariff shift method, tariff shift method, the dial and the screws both meet the shift. So the dials in 392690 and the screws are in 731815. Those both shift to become part of the finished good of 830300. But the safe body does not meet the shift, and it is non-originating, and therefore my finished good is not originating. So my safe body, 8303, does not shift when I end up with my finished good, which is my armored safe of base metal of 830300. So I cannot qualify my goods for USMCA. However, problem with copy paste. If I just change one element, if I change my safe body to being of Canadian origin and it being originating, then even though my safe body does not meet the shift, it is still originating, and therefore my finished good is originating. So I can qualify my good by ensuring that either my goods meet the shift or the goods that do not meet the shift are themselves originating. My finished good can be originating in that circumstance. So hopefully that illustrates how tariff shift is applied and when it doesn't apply, and how you kind of need, what factors you need to look at. We're looking at the USMCA rule, the classification of the finished good. We've identified the components that go into the finished good, their classification, their country of origin, and their originating or non-originating status. If I have all of those elements, I can make my determination. If I'm missing some of those elements, I'm going to have a hard time determining whether or not my good is originating. It's not that it's impossible, but it becomes much more challenging to do so when you don't have all of the facts. And it makes it very hard for you to prove that your good is originating. So we want to make sure that we get that information. All right, regional value content determines whether the accumulation of originating content meets the threshold for a particular good. And we're on the right side of this slide. Based on the monetary value. It's important when we're talking about regional value content, we're talking about value, we're talking about money. Tariff shift is not talking about money. Tariff shift is talking about the tariff classification exclusively. So with regional value content, there are two calculation methods available to us. And these are the same as they were under NAFTA. But the transaction value method states that RVC, the regional value content, is equal to the transaction value minus the value of non-originating materials divided by the transaction value. And you're ending up with a percentage by doing it, the math this way. So it's simple percentage math. You just have to have what the values of TV and V&M are. The other method that you can use is the net cost method. The net cost method, RVC, is equal to the net cost minus the value of non-originating materials divided by the net cost. And again, you end up with that percentage. And basically, regional value content is stating that the regional value content, if it meets or beats the threshold, then the finished good is considered originating. But you have to read the section heading and tariff item note before proceeding to the HTS item for qualification. You have to understand what rules to apply and how to apply them within the regional value content calculation methods. So an example of RVC in practice, the USMCA rule on a B12 vitamin supplement classified under HTS 300450. The rule is a change to heading 3004 from any other heading except from heading 3003, or no required change in tariff classification to heading 3004, provided there's a regional value content of not less than 60% using the transaction value method or 50% using the net cost method. So in this USMCA product specific rule for 3004 here, we have either a heading shift under heading 303, a heading shift to 3004 from any other heading except from 3003, or we can use the regional value content calculations. And under RVC, we get two choices. We can choose to use transaction value method, or we can use the net cost method. So I take a look at my bill of materials for my finished good for my B12 vitamin supplement. I've got some water from Switzerland on there at 12 cents. That water is non-originating. It's classified in 220190. I've got vitamin B12 under 2936.26, which is US and it is originating. It's worth 41 cents. And I have some ground powders from Italy, which is 300450, and it is non-originating, and those ground powders are worth 63 cents. In addition to those components, I have labor and overhead provided here in the US that is considered originating, and it accounts for 34 cents of my overall material. So my material cost in this, if we do the math here, it should add up to 150 unless I've messed up. And my sale price for the goods with a 20% profit is $1.80. So if I apply my transaction value method, I would take the transaction value minus the value of non-originating materials. So my $1.80 is my transaction value price. I subtract out my non-originating materials, which are the water and the ground powders. That comes out to 75 cents. I divide that into my transaction value, and I come up with 58%. I have not met the threshold, and therefore my good does not qualify for USMCA under the transaction value method. However, if I use my net cost method, I can take the net cost of my goods, subtract out the value of non-originating materials, still 75 cents, divide that into my net cost, and I get 50%. I have met the threshold, and therefore my good does qualify under USMCA. And the way these rules are written, I'm allowed to use either the transaction value method or the net cost method, whichever I prefer to use. As long as my goods are going to qualify and I can prove it, I can use that method. Hopefully that illustrates how to apply the RVC method, the regional value content method. It is a little bit of math. It's not particularly complex math. Again, the burden is on having the facts going into doing your calculations. If you do not have some of the facts, maybe you don't know whether the vitamin B12 is originating or not. You have a presumption, there's a presumption of non-originating unless you have proof to the contrary. So if you don't have proof, then you can't, you cannot assume that your goods are originating. And that'll get into our certification and substantiation requirements. Okay, so the certification process, some key facts here. Certifications do not have a required form. There is no prescribed format. And I do not recommend using the general FTA certification form that Customs puts out there that is supposed to be fine for all certifications. It's not quite fine, and it's kind of cumbersome and difficult, so I wouldn't recommend that. I'd recommend creating your own form and using that, or following the form that your suppliers or your customers ask you to use. That's usually better than using something that CBP has put out there. Certifications may be provided on an invoice or any other document, except on invoices or commercial documents issued to an entity in a non-party country. So if the goods are shipping to Mexico, but you sold them to a company in China, you can't use that invoice, the invoice from US to China, as the place where you make your USMCA claim. It has to be on a document that is used between the US and the Mexican companies. And generally speaking, you're going to want to create your own specific form just for that purpose. But in theory, you can just print it on your invoice. We found in most cases that people prefer to have their own document. You have to include all of the minimum data elements that are outlined in Annex 5A of the agreement. We'll look at that in the next slide. The documents may be completed by the exporter, but the producer or the importer, but the importers have special proof requirements that are spelled out in 5.2, 2A through D of the agreement. So if you want to be an importer and make your own certification and your own claim without the benefit of exporter or producer documentation, then you have to follow those rules there. You can use any language to complete the certification, but you may be required to provide a translated copy to Customs upon request. I have not seen this be a conflict yet, but there is a potential here where your Canadian suppliers are providing you a French certification and you don't know what it says. You may have to go get that translated on your own dime, but I haven't seen it really crop up. And then you can use digital certificates with electronic signatures. Electronic signatures are not the same as a picture of your signature added to a document. That's a different thing. That's not an electronic signature. That's a picture of your signature. Electronic signatures are a specific element of your of certain softwares that allow you to digitally sign your goods, your documents. All right, so the minimum data elements, I'm not going to read through all the text here, but at the face, you need to have the type of the party that is certifying the goods. You must specify whether the certification is being provided by the importer, the exporter, or producer. Then you must identify the certifier, the exporter, the producer, and the importer. Again, those same four parties that we talked about at the very, very top. If your exporter is the same as your certifier, or your producer is the same as your exporter and your certifier, you don't need to spell out that same party over and over again. You can just write same or don't even include it. You just identify that you are all of those roles. You need to provide the HS and the description. The HS is the 6-digit level HS. Description should be sufficient to relate to the good. So if your description is just a numeric code that identifies your product, that's not sufficient to relate to the good. You must explain what the good is. Usually whatever description you use on your invoice or on your product listings internally. And I also like to include the HS description of the good, just to make it very clear what we're talking about. And if it's a single use certification, then you should provide the invoice number for that certification. Identify the origin criteria from Annex 4.2. So that's going to be your wholly obtained or produced from components exclusive within the parties, and so on and so forth, A through D there. Blanket period, if it's multiple shipments, you would include all the months where the certification is going to be valid, up to 12 months. It is typical for companies to run on the calendar year cycle, so January 1st through December 31st. There are some industries that are running on a mid-year cycle because of the date of the USMCA implementation, where it is July 1st through June 30th. So pay attention to your blanket periods more so than you were during NAFTA, because it could be relevant to how valid your certification is. And then you must provide a signature and the following statement, as well as the date the certification was signed, that you can copy to your certification there. And because of all these data elements, it's often not smart to just roll it into your commercial invoice. It's too much change. It's often better just to have a separate document for it. So in order to meet the qualification requirements, you're going to need a valid HTS. These are the cornerstones of your certifications. you have to ensure that you have documented accurate HS determination on both your finished goods and your components. If you don't have valid HS, then your entire premise for your qualification is likely to be off. Or if you're missing key components in your bills of materials and you don't have their HS, your goods may not be qualifying, and you may be none the wiser because you just don't have a number in there. You need to find, read, and apply the appropriate rule of origin to your goods. So starting with your HS, go find your rule of origin, look at the section and chapter precedents to make sure that you have all the elements there. Recognize if there are any special rules that apply. Most of the rules will tell you where else to go if you've got a special rule that you need to pay attention to. And also consider whether you qualify for a special rule like de minimis, or know if you need to be applying your tariff shift or your regionality content, or both. Do you have automotive goods? You need to look at different sections of the agreement for any special provisions. So make sure that you're finding all of the relevant text of the USMCA, but start with your rule of origin for your HS number for your good. And then substantiating evidence. This is really, how do I know if my components are originating, if my finished goods are originating? How do I prove that? And you should be understood that just knowing that the components are originating is not sufficient for customs purposes. They need to know it. They need to understand it. Just because you know exactly how your goods are produced, if you don't have evidence that backs up what you state that you know, then there is a presumption of noncompliance, and you'll be penalized for not having the records that are required in order to prove your qualification. So you must have that substantiating evidence in hand at the time the claims are made. If they promise to get it to you by the end of the week and you make your claim anyway, technically you're in violation, and you could be penalized for that. I haven't really seen that happen often, where a claim is invalidated, but you could be penalized for noncompliance with the program. It's also worth noting that the agreement allows you to go back and retroactively claim any duties that were paid if you later find out that the goods were eligible for USMCA, but you did not claim it at the time of USMCA or at the time of import. So you became aware of it after the fact. You can go back and get the money, the duties that were paid to the government. And evidence can include a bunch of different documents: cost of bill of materials, your supplier certifications of origin, your methodology for meeting your rule of origin, any certifications that you issued to your customers, keep your records for 5 years, verification of payments made and collected, production processes, commercial invoices. All of these are part of the pieces that will be looked at and scrutinized in the event that there is a verification visit made to your facility or a verification questionnaire sent to your facility. They're going to want you to produce these kinds of documents to illustrate clearly to them and without question that the goods are qualifying for USMCA.
Michael, we have a couple of questions.
Okay, well, I'm at the end, so we can give me this one slide.
Oh, perfect.
Yeah. So there's plenty of time for discussion. So participating in USMCA obligates you to certain regulatory requirements, and failure to fully meet those requirements can result in penalties. Methods and practices for implementation vary widely. I've seen a lot of different practices in place, but the results need to conform to those requirements. So it's important to understand that requirement. And here we are. Just as a closing, we'll tackle the questions here after we stop the recording, but this webinar is eligible for 1 credit, so please submit that request to train@starusa.org. We hope you had a good time, and those of you interested in the Q&A, please stick around, and I will stop the recording now.